Welcome back to Halftime. Let's get to our call of the day. Morgan Stanley cutting Disney's price target, saying that the Hollywood strike is weighing on the industry. Sarat, you own Disney. Do you agree with this call? And how long-term do you think an impact could be?
It could be for a long time. I mean, for us, Disney's a value stock. There's no short-term catalyst. We don't know what it's going to be. Iger's going to be there for a couple more years. Our view is, look, the sum of the parts is greater than the whole. They have great content. They have a great global brand. The time to own some of these stocks when they're so out of favor is now. But again, you know, it's like when Meta was 90, and you could sit here and we talked about how bad things were and it could be on the way to 60. But there is a case for us that there is value there. Is it there in the short term? No. Did they raise prices too fast? Yes. Did they spend too much money on content? Yes. Is linear TV going down? Yes. But at the end of the day, this brand, people still talk about it. They've got so many things with Marvel, Star Wars, etc., that there is value there. And Iger would not have stayed on for a couple of years because this is his legacy. And I do think that there's a good company behind it and there will be value there. But in the short term, if you're a trader or you're looking to do well in the next 3 to 6 months, it might not be the spot to be.
Is there value in the ESPN content? It seems like they can't quite figure out what to do with that.
Well, I think live sports has huge value, and ESPN does have that global brand. So the question is matching your assets to liabilities. How much are you paying for the live sports versus how much you're getting? And there could be other ways to do it. Maybe you just spin it out and it becomes a completely separate channel. Things that other, channels are doing as well. So there is value there. It's how do you create it?
Right, that's a big question. And actually, Scott Wapner has been out west this week for CNBC and Boardroom's Game Plan Conference, and he spoke with the co-owner of the New Jersey Devils and the Philadelphia 76ers, David Blitzer, about the future of live sports. Here's what he said.
We all know that live sports is the best content around. You can't save it, you can't watch it later, and so the value of content is going to continue to grow, in my opinion, above inflation.
Liz, what do you think about the value of live sports?
I mean, first of all, I love live sports. I'm one of those women that I'm like the only woman in Manhattan that has the NFL Sunday ticket and the MLB package. And I agree. I think the value of the content will grow. The advertising space has to change because you can now get live sports on a computer. You can get it on your phone. You can stream it. So the ad space changes, and the days of Super Bowl commercials being the most valuable piece of advertising ever may go away. But the value of live sports will continue growing. I absolutely believe that. The one caveat is that the type of sport, I think, will change, right? People aren't quite as interested in baseball as they continue to be in football. Soccer has become much more popular here. So that's something that I think advertisers need to keep up with as trends change. But I do agree that there's money there. You can't replace it. There's no competition to live sports.
Pickleball TV coming soon?
Yeah, no. Maybe.
Joe, I know you're not really as much of a fan of Disney, though. You're playing streaming in a different way. Netflix is your game.
Well, I think ultimately Disney is going to have to figure out how to monetize that asset, and it's been somewhat confusing to me why they haven't introduced gaming. Yes, I've been talking quite a bit about Netflix over the last several weeks. Let me just be explicitly clear on this. At the end of April, it was added to the JOTI ETF at $330. So it's $418 as we speak today. We will rebalance and reconstitute on Monday. Netflix right now, in a comparison to the NCAA tournament, is on the bubble. And it's on the bubble because this is the 5th trading day since it reported earnings last Wednesday, and you're not seeing any significant bounce at all. So what happens in that is that the momentum factor, which was intense, it was incredibly strong, it's beginning to wane. And as that begins to wane, you look a little bit towards the quality side. Now, this is a company that's improved its balance sheet, but the problem is that the sales growth is on the decline over the last 12 months relative to the last 3 years. The average sales growth over the last 3 years is 19%. Unfortunately, over the last 12 months, that sales growth has contracted 4.5%. So this is a stock right now where you've got this conflict between two factors. We'll make a decision what to do with it on Monday. If you're isolating on momentum, you stay with it. But if you're including quality into it, the decision will be made on Monday, and we'll see what we do with the position.
Weiss, when you're looking at playing the streaming wars game, what's your pick?
Well, I think Netflix stands alone. They don't. It's a clean story, so it's not like Disney, where they've got legacy businesses where it's clouding the picture.
But then there's less diversification.
Yeah, and sometimes that's a good thing.
Okay.
You know, Warren Buffett says you don't make money by diversifying away your returns, so you want to concentrate portfolio. So I think they are in good seats. It's no surprise that earnings growth has declined. I mean, over the last 3 years, you've had the pandemic and everybody rushed in. But I still think they've got the best content. They've got good management doing it, and they don't have live sports really.
No.
But you know, live sports content's king. But it's when you own the content, not when you have to buy it. So buying that content is incredibly expensive, and I don't know that you get the return on it. Yet legacy TV would buy content because it would lead into their primetime viewing. But now that's not really relevant at this point. So you know, it's great for David to talk about it because he's the guy that owns the content.
Sure.
But for others, it's not as good. So going back to your original question, I think Netflix is the only way to play. You play at the right time. I bought it as a trade. It's been a horrendous trade. Momentum's died. But that's when you have to buy Netflix. Did I buy too early? Obviously. Can I get under 400? Possibly. Yeah. So,
Whenever I think about pandemic and Netflix, I will always think of the Tiger King. Didn't we all watch that?